Good morning, everyone. The U.S. market opens, and what an absolutely wild night it has been in the silver market. The situation has escalated dramatically, and this week is shaping up to be one of the most critical we've ever seen. Right now, as I'm recording, there is a massive, and I mean massive, arbitrage gap between the silver price in New York and the price in Shanghai. Here are the numbers. U.S. silver is trading around $69.60. In Shanghai, it's trading at $70.15. That's a 55-cent gap. Now, for those of you who follow the markets, you know that arbitrage gaps like this, especially in a liquid market like silver, are supposed to close within seconds. Traders would normally buy the cheaper asset and sell the more expensive one, pocketing the difference and closing the gap. But this time is different. This 55-cent gap has been open for hours and it's not closing. In fact, it's been widening. So what's going on? The reason this gap isn't closing is simple and terrifying for the paper markets. Traders cannot get their hands on enough physical silver in New York to ship to China and close the trade. The physical silver shortage is now so acute that it's literally breaking the arbitrage mechanism that holds the global market together. China is willing to pay over $70 because they need the physical metal and they can't get it. This is the moment we've been talking about for years. The paper price of silver is being exposed. We are witnessing the beginning of the great decoupling, where the price of physical silver detaches from the paper contracts traded on exchanges like the COMEX. Overnight, we saw a desperate attempt by the banks to suppress this gap. They tried to smash the price down, but it failed within minutes. The selling pressure was immediately absorbed by a wave of aggressive buying from Asian industrial users. Think about the demand for solar panel manufacturers, battery makers, and electronics companies. They saw the dip and pounced on it, pushing prices right back up to the highs. This is incredibly bullish. It means the U.S. market is set to open near its highs, not showing any weakness despite the overnight attempts to manipulate it lower. The shorts who tried to suppress the price have only made the situation worse for themselves. As we head into the COMEX Open, the price is hovering just below that critical $70 mark. I see two primary scenarios playing out today. Let's call them Scenario Alpha and Scenario Bravo. Scenario Alpha, which I give a 70% probability, is a gap up. This means that as soon as the New York market opens, we'll see an immediate surge in price as arbitrage funds rush to buy U.S. silver to close that huge spread with Shanghai. If we break above $70 within the first 10 minutes of trading, the path to $72.50 could open up very, very quickly. Keep an eye on the volume. If we see more than 15,000 contracts traded in that first hour, it's confirmation that the big institutional players are chasing this move. They see the physical shortage and they want in. Now, for Scenario Bravo, which has about a 30% chance of happening, I call this the morning trap. The banks are not going to give up easily. We could see them use the release of economic data around 8:30 a.m. Eastern as cover to dump a massive amount of paper contracts on the market. This could trigger a fake crash, maybe down to around $67, designed to shake out the weak hands and create panic. But here's the key. If you see this happen, look at Shanghai. If the Shanghai price remains firm at $70 while New York drops, you know it's pure manipulation. Also, watch the volume. A drop on low volume, say less than 8,000 contracts, would be another signal that it's a fake move. That old resistance level at 67.50 is gone. It's now a major support zone. Regardless of which scenario plays out, the underlying message from the market is crystal clear. The arbitrage gap is screaming that physical silver is worth far more than the paper price suggests. One of these markets is lying, and all signs point to the paper market being the one that's disconnected from reality. The banks are terrified of a move to $75. At that price point, we could see an explosion of industrial FOMO, fear of missing out, as major corporations realize they need to secure their physical supply at any cost. The industrial demand is the floor under this market. They are absorbing every single dip. So my message to anyone holding physical silver or shares in mining companies is do not let them shake you out. Do not panic sell on a manufactured dip. The fundamental driver of this market is the physical deficit. It's not speculation, it's real-world supply and demand. The paper market is rapidly losing its relevance as the physical price, led by markets like Shanghai, takes control. The Shanghai price is the true signal right now. I'll be monitoring the market action intensely, especially between 8:20 a.m. and 9 a.m. Eastern, right around the open. If we get a decisive break above $70, or if we see that arbitrage gap suddenly start to close, I will come back on with an emergency update. Things are moving very, very fast. So, buckle up. This is it. This is the week where the physical silver shortage becomes undeniable to the entire world. The cracks in the paper market are turning into gaping holes, and the true value of real physical silver is about to be revealed. Thanks for watching. Stay tuned, and I'll talk to you all again very soon. Make sure you're subscribed so you don't miss the next update.